Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and we're excited to have you join us today. We're starting off with a look at some of the biggest stories in the financial world. First up, Apple is set to release its second quarter earnings on April 30th, and investors are eagerly awaiting the results. The company has been dealing with leadership changes, including the announcement that CEO Tim Cook will be stepping down, with John Ternus taking over the role. This transition has introduced some uncertainty into the market, but analysts are still expecting solid earnings growth for the quarter. One of the key factors driving Apple's financials is the strong demand for its iPhone. Despite some supply constraints, the company is expected to report significant revenue growth, driven by upgrade activity and switching from competing platforms. The services segment is also expected to continue driving profitability, with growth spanning advertising, digital content, payments, and cloud offerings. However, there are some headwinds that Apple needs to navigate, including margin pressures linked to rising memory costs and supply constraints. These challenges could weigh on the company's gross margins, but analysts are cautiously optimistic about the company's ability to offset these pressures through a favorable product mix and operating leverage. Looking ahead, Apple's installed base of over 2.5 billion active devices provides a significant foundation for long-term growth. The company's ecosystem strength and evolving revenue mix also support a positive bias towards the stock. However, with elevated volatility expectations, short-term traders may want to approach with caution. We'll be keeping a close eye on Apple's earnings release and its impact on the market. In the meantime, we're also tracking other major stories, including the latest developments in the oil market. Crude prices have been volatile in recent weeks, driven by concerns over global demand and supply disruptions. We'll be exploring these trends and more in upcoming segments. For now, let's take a break. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone, folks. We're diving into the world of tech and finance, where the lines between innovation and speculation can often blur. Today, we're focusing on Intel, a household name that's been making waves in the semiconductor industry. As we explore the latest developments, remember, our goal is to provide you with balanced insights, helping you navigate the complex landscape of investments. Intel, with its market capitalization of $331 billion, has certainly seen its share of ups and downs. Recently, the company has been gaining traction due to strong demand for AI PCs and server CPUs, fueled by advances in agentic AI that have boosted both the client computing and data center segments. This resurgence in demand, coupled with geopolitical shifts favoring U.S. manufacturing, has rebuilt investor confidence. Over the past 52 weeks, Intel's stock has seen a significant gain of 251.7%, and it's been up 79.57% year-to-date. However, as with any investment, it's crucial to look beyond the surface-level numbers. On a forward-adjusted basis, Intel's stock is trading at a price-to-sales ratio of 6.12 times, which is notably higher than the industry average of 3.19 times. This could indicate that while there's optimism about Intel's future, some investors might be pricing in more growth than the company can realistically deliver. Street analysts have robust expectations for Intel's bottom-line trajectory, with EPS projected to surge 166.7% annually to $0.08 in the current fiscal year, followed by a significant increase in the next fiscal year. Yet, analyst views on Intel's stock are mixed. Some firms, like Stifel and Bernstein, have expressed optimism about the company's turnaround due to data center demand and its foundry relationships with major players like Google and Tesla. Others, such as KGI Securities, have downgraded Intel due to potential challenges from current market dynamics and competitive pressure. The consensus among Wall Street analysts is a hold rating, reflecting a cautious stance on Intel's stock. With a consensus price target of $52.54, there's a potential downside of 20.7% from current levels. However, the street high price target of $92 suggests there could be a significant upside as well. As we consider these perspectives, it's essential to remember that investing is about making informed decisions based on your own financial goals and risk tolerance. Intel's story serves as a reminder that even in the tech sector, where innovation can drive rapid growth, careful analysis and patience are key. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's take a closer look at two tech giants making headlines in the market, Qualcomm and Applied Materials. Qualcomm, a leader in the semiconductor industry, is facing challenges due to declining demand for smartphones and increased competition from rival companies. Despite this, the company has reported better-than-expected earnings thanks to its diversified product portfolio and growing demand for 5G technology. However, investors are cautious about the company's future prospects, given the intense competition in the industry. On the other hand, Applied Materials is riding high on the wave of surging demand for AI chips and improving semiconductor spending. The company has reported strong quarterly results, with revenue and profits exceeding expectations. Its involvement in Elon Musk's Terafab chip project has also generated significant buzz, with investors cheering the prospect of a huge new customer. However, it's essential to note that Applied Materials stock is trading at rich multiples, with a forward price-to-earnings ratio of around 35 times, far above the tech sector median. This raises concerns about the stock being overvalued and potentially due for a correction. As we analyze these developments, it's crucial to remember that the tech industry is highly volatile, and companies can quickly rise or fall depending on various factors. Investors must be cautious and conduct thorough research before making any investment decisions. In conclusion, while Qualcomm and Applied Materials present interesting opportunities, it's essential to approach these investments with a critical eye. Consider multiple perspectives, weigh the risks and rewards, and always prioritize a well-diversified portfolio. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.